Hello and welcome to Investing Confidential. So they did it last night. Bank of Japan, basically, as you can see here, they are allowing their the JGBs, their 10-year bonds, to basically trade wherever. I mean, they eliminated this cap. They've had this sort of official, unofficial cap uh, at negative rates at 50 basis points, and now they're saying 1% or more. And I think this is what I think the market reaction in Japan was right. I think the market reaction internationally was completely wrong. The talking heads have it completely wrong, and I'm going to show you why. So, and I'm going to tell you also, this is huge. This is massive. This is important. If you own bonds, if you own stocks, if you don't understand the repercussions for this, it's gonna come back and bite you hard, very very hard. So let's go through it. So a little history. Japan has been on. Japan had this peak. Their markets peaked. They were a powerhouse in the 80s up until about 1989, when their stock market, which was trading at like 1,000 times earnings, just absurd, peaked out. Even one bedroom apartments in Japan were going for like $10 million. I mean, it was out of control, and the market blew up like every other market. And obviously, like we saw with China a couple of years ago, by the way, which is also busted. That Japan is going to take over the world, blah 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 blah. Look, Japan, like China, is no authoritarian country. Okay, despite what you being a kind of democracy, Japan is ruled they still have like a king, a prince, whatever they call him, and it's ruled by the elite class, and it's always going to be that way. And whatever they say goes. And when their bubble popped, they decided they went through all these documents and studied these moron economists from Princeton and other places, and they decided they're going to go to this QE. Okay, they decided. Remember QE that we did? Okay, Japan started this way before anybody else. They were going to manipulate their bond market to drive rates down because their economy basically busted. Their stock market busted. Everything busted. Their currency busted, and they were going to reduce rates to the point and make it negative so that they can spur on growth. So they started with this QE, and basically for 30 years it didn't work. 30 years. It took 30 years for the stock market to come back. So Japan has been in a bear market for 30 was in a bear market for 30 years. Okay, and all of this bond buying, negative rates for 10 years, which is what they've had, did nothing to spur the economy. Absolutely nothing. They were trying to spark inflation, everything manipulated, and it did nothing. Okay, and it's continuing. And so what has happened, if you could look here, okay, let's look at the current situation. Again, this is after 30 years of QE. Industrial production down, negative. I mean, this is the economy. This is an economy that's been in essentially stagflation over the last 3 years. Has been in depression, kind of a depression, uh, but a low to slow growth and a weakened currency for many many years. The only companies that have done well in Japan, obviously, are exporters like Toyota, Honda, etc., which basically shipped all the jobs over, and it didn't matter for Japan because their population is so small. So today, after all that QE, after all this nonsense, you've got negative industrial production, as you can see here. It is an absolute disgrace what the government of Japan has tried to do. It hasn't worked. And then the morons in this country try to do the same thing. QE, rates to zero, again, didn't work. Because if it did work, they would have stopped, but they didn't stop. They wanted negative rates forever. And this is why we're in the situation. But let's go back to Japan. So this is the catalyst. As you can see here, CPI, inflation, okay, through the roof. Now, you got to understand the numbers here. Japan has a up until a few months ago, Japan had their long-term bond was trading at 50 basis points. 50 basis, so negative yields. They've had negative yields for almost 10 years. So what happened is that all of the money, pension money, corporate money, even it's been flying overseas, investing in the U.S. and Europe, hedging their currency, which costs at anywhere from 2 to 5% depending on the year, and they have better yields overseas with the hedge, so they've kept their money overseas, and there are hundreds of billions, hundreds and hundreds of billions of Japanese money invested in the U.S. and European bond market. Okay, and that's the that's the situation up until recently. And so what happened last night is because of a weakening economy, because of a weakening yen, okay, and it's been weak for a while, and it continues to be weak. And they had to do something, and the bottom line is they had to stop manipulating their bond market. Okay, and they've been manipulating their bond market for a very, very long time. And it's called, as I said, again, I mentioned again, they've been doing financial repression for a very long time, for years and years and years. They've been printing money and buying their own bonds, forcing any domestic company that couldn't get their money out, forcing them to buy, again, to keep the bonds artificially low. And if you don't think the White House today and the Fed would like to do that aggressively, you're smoking something. Because the U.S. has got a major problem. And you could see it now. Our interest on our debt is skyrocketing because every time a bond comes due, the yield goes up 2 times, 2x, 3x. And there's a lot more to come, but I'll go back to the U.S. another time. So the current situation is this, yields, as you can see here, had been going up, and now they're exploding. Okay, after the announcement, as you can see back in the summertime, we first spoke about this, by the way. This is when we first talked about this. You had this 50 basis point artificial cap. It just plowed through it, absolutely plowed through it. And now the government put a quasi 1% cap. Guess what's going to happen, folks? These rates are going to whip through 1%. And once they whip through 1%, considering even with the hedge and what's going on in the U.S. bond market, you're going to see a flood of money coming back into Japan from Japanese. And where's that going to come from? Selling U.S. bonds, treasury bonds, corporate bonds, and same in Europe. Okay, so this chart here showing the 10-year government bond at around 95 basis points. This thing's going to go, who knows where it's going to go? Nobody knows because there's no more cap. It's sort of an implied cap. And it's going to rip through the roof. And the money is going to flow back like you've never seen before. And this is what the morons who are looking at the action. So here's the yen. Okay, now the yen, this is the headline of the Financial Times saying yen under renewed pressure following BOJ policy tweak. So the talking heads are saying, well, they didn't do enough. They didn't do enough, and that's why the yen's under pressure. These guys don't know what they're talking about, because the bottom line is the yen is going to strengthen here, and it may go up to 152, 150, may blow out a little bit here. But that's an opportunity, because when that money starts flowing back, okay, you're looking at the yen chart here, right? When that money starts flowing back, the yen will start to appreciate, as will the stock market, because the money's got to go somewhere. It's going to fly into the bonds, it's going to fly into stocks, it's going to fly into the currency. And this is what the Bank of Japan is betting on. Okay, they're not dumb. These guys have been manipulating for quite some time. They know what they've done, and they know what's going to happen. Okay, because you see here, what they've done doesn't work. Okay, so in here you see the chart of the 10-year bond in Japan versus buying, the financial repression, manipulation of the bonds. They buy, buy, buy. It doesn't work. The bond, they've been trying to manipulate their own bond market for quite some time. It doesn't work. And boom, now the market has control of it. Now the market has control of it. And as soon as this tsunami, and I hate to use that analogy, but as soon as this tsunami of money starts flowing back in, that currency is going to start to strengthen. And the effects on the US bond market, stock market is going to be devastating. I mean, not stocks, but stocks will react because no matter what economic numbers come out, our rates are going to stay up over 5%. It may go higher. And no, everyone's going to be scratching their heads. The idiots on CNBC will be going, no, this shouldn't be right. No. It's probably happening already, but it's going to be a tsunami, folks. And it's going to affect corporate bonds. It's going to affect treasury bonds. And with rates staying up at these levels, and we got very weak growth coming in. There's no doubt in my mind. We've got sticky inflation and very high bonds. That is not necessarily the kind of backdrop you want to own stocks. So despite what everyone is saying out there about the weakening yen, you're going to see a reversal. And maybe that should be your trigger point, watching the yen. But as I said a couple days ago, you want to own Japanese stocks for the currency, okay? EWJ, there's a bunch of ETFs out there. You can pick and choose. You can even buy, whatever. It doesn't matter. This market has finally broken out of a 30-year bear market. This is why Warren Buffett has loaded up on Japanese stocks. The weakening yen since the beginning of 2023 is an opportunity as a dollar investor to go in. So despite this negative situation in Japan about the economy and all this, it's going to turn out to be a positive. But it goes back to what I said before about the US. It's going to be a real bad negative for the US. So if you're a US investor, you got to be very careful. But it's time to start looking offshore, places like Japan, if you want to make money over the next few years. Okay. And as always, because of this volatility, as an investor, you need to be careful out there.